Just close the fucking door. Close the door.
No snap. Welcome back, everyone. We are back to yet another FOMC day. This is exciting. We had CPI yesterday coming in pretty much at expectations across the board. Things looking good. We got PPI this morning. Big misses across the board. Of course, PPI can lead into future CPI misses. This is pretty exciting, though, because a lot of folks are saying finally we are getting to the point where we might actually see disinflation take a hold in our country. And this is great. Not only are we exporting deflation, or should I say importing deflation from China and Germany, but now we're hearing that Etsy is starting to lay off 11% of its stock in a very challenging environment. Yikes. About 225 people from Etsy getting cut, which is really interesting because you've started seeing some of these consumer stocks really start kind of moving here, especially some of like the apparel stocks. So starting to see some of the discretionaries like Etsy now come out and say, I don't know, man, we got some issues. Are going to lead us to start scratching our heads a little bit about how aggressive of a Fed do we really want here? How seriously aggressive do we need to get here? All right, here we go. So we are, let's see here, 10:56. We're about 4 minutes away from our new summary of economic projections. The current set of economic projections are right here. Somebody here actually just left a comment. I run an Etsy store and there is zero male representation. Okay, Alan. Do you mean like clients or store runners? I do think it's probably a female-dominated business. You're probably right about that. It's a good point. But anyway, these are my expectations versus the September expectations for the Federal Reserve. As you can see, we're going to be looking very closely at these numbers here in a red and the black next to them. The red are mine. These are sort of the direction that I think we'll end up going. I think we're going to get those two cuts priced in by the Fed next year. Keep in mind, the market is pricing in. They can have a dual mindset here, right? Like you could believe the Fed is pricing in 2, but actually think the Fed is going to give you 4 rate cuts. That's what the market is expecting on both sides right now. The market's thinking Jay Powell is going to tell us 2, but we're going to end up getting 4. Look at that. Under promise and over deliver. That'll be really entertaining. So we'll see what happens. The release comes out in about 2 minutes. Obviously, we'll be watching that very closely. So pretty excited to see what the numbers actually come in with. Then we've got the unemployment rate. I think it'll tick up a little bit. We'll see what happens. We're expecting, obviously, rates to stay flat. That's like nobody's expecting a move here. Any kind of move here would be very bizarre. Most folks, I mean, pretty much there's nobody estimating that anything else is going to happen. So it would be very, very strange to get any kind of change on the rates here. But the projections are going to be what everybody cares about. It's all going to be about these projections. I think we're going to be looking for a slight uptick in unemployment, slight downtick in the inflation expectations. We'll see. Unusually large number of significant factors in play for today's meeting. The modern Fed essentially makes policy via forward guidance. And a year ago, the Wall Street Journal predicted the Fed would go down from 75 to 50 basis points before one of last year's hikes, and then sure enough, they did. So it does seem like the Fed's really into kind of leaking or forecasting what they want to do. Point of that is to say, we don't expect any kind of big rug pull, although you never know what you're going to get. Although I think the big thing here is going to be all in on Jerome Powell's testimony. What Jerome Powell says and how we should interpret those SEPs is going to be critical, in my opinion. So we'll cover this, obviously. Nick here is freaking out in the chat. Is that Nick T? Nick T, when are we going to do an interview there? Does he read the public chat? Oh my gosh, he's not answering instantly.
Go yourself. Is that clear?
So anyway, all right, we got about 40 seconds to go to get the numbers. And then we're going to put a bingo card together when we actually, in the next 30 minutes, because it'll be 30 minutes before Jay Powell's actually up. Okay, let's see what we get. As we can see, stocks are kind of a little depressed going into this meeting. And it is, boom, 11 on the dot. We are waiting now for the actual data to start coming across the tape. And we are waiting. Any second now. Come on. Okay, Fed keeps the rate the same. Not a surprise at all that we got the rate the same. Fed says inflation, reading the tapes right now, Fed says inflation has eased over the past year, but remains elevated. Fed will assess the extent of any additional firming needed. This sounds consistent. Forecast, here we go. Forecast, wow, 4.6. Let's go. I was thinking 4.9. That's pricing in 3 cuts. Fed is pricing in 3 cuts for next year. Market was looking for 4, but market thought the Fed was going to tell us 2. They're actually going for 4.6. That's freaking fantastic. Okay, let's go. And then we're getting PCE forecast declines to 2.4. Okay, that's great. That's kind of what I was thinking too. I want to actually compare that perfectly as soon as we can get the darn projections here. We're waiting for them. Projections. Got them. Okay, they're coming up. And I'm reading them across the tape as we go here. We've got Treasury yields plunging. Let's go. Stocks up. Let's freaking go. It's happening, boys and girls. Fed's going to go dovish. Rah! Watch, it all crashes by the end of the day, and everybody can make fun of me in the comments. All right, you ready for this? Let's compare. How close was Kevin? I said, what did I say? I said 1.2. We got 1.4. Okay, that's good. That's good. I prefer that. Okay, unemployment rate, I said 4.2. We got stable at 4.1. Okay, all right, I'll take it. That's fine. PCE inflation, Fed gave us 2.4. I said 2.4. Let's go. Okay, we got a match. And then they go for 2.4 on core PCE as well. I said 2.5 on that one. So I only got 1 out of 4 of these right. I'm going to give myself a little honorary check mark there. This is amazing, though, right here. Everybody thought they were going to go for only signaling 2 cuts. They literally just signaled 3 cuts. Woohoo! Let's go. That's great. Let's look at what the range is. Look at the range. That's central tendency. Look at that range, 3.9 to 5.4, with a central tendency of 4.4 to 4.9. So I'm definitely on the more hawkish side. That's really ironic for the Fed. We've got, Treasury yields falling now. This is absolutely great, though. This is very, very good for, everything. It's real estate, it's jobs, it's loans. Yes, let's go. 10-year down 13.5 basis points. Let's freaking go. Okay. Then let's look at the actual dot plot here. Okay, dots. Here we go.
Just close the fucking door. Close the door.
All right. What is this? So everybody's unanimous over here. This is pretty it's getting tighter, should I say? Look how tight this is over here. Okay. So how do I here? Okay. There we go. Okay. So that's getting tight. We've got 3 people who think we're going to stay above 5% in 2024. There's 1 person. Who is this? Is that Bullard? There's literally 1 person at the Fed who's like, we staying high forever. Look at this. They don't even want to cut much lower until 2026. Like, they want to see the first rate cut in 2026. Here's somebody who's scarred by the 1970s. They're probably buying gold. Oh, I just offended a lot of people. I'm sorry. I apologize. So anyway, pretty confident we're going to get into that 3% range here in 2025. Looking like we actually break into the 2s. Look at that, folks. The 2% range again in the 26 range. This is fantastic. Very good. Very good. Rip Schiff. Yeah, no kidding. This is good. This is very good. Okay, I'm looking for a little bit more signal here and tape reads. Let's see what we have. We have Fed will continue bond holding reductions as previously planned. Vote in favor of policy change of stability was unanimous. Financial and credit conditions are likely to weigh on economic activity going forward. Hiring and inflation, all of that remains uncertain. Yeah, that's not a surprise. Let's see here. Okay, then we've got job gains have moderated but remain somewhat strong. Rates remain low. This is from the statement, right? Statement. Anyway, here, let me just do this. Okay, tighter financial and credit conditions are likely to weigh. We saw that determining extent of any policy firming. They'll take into a range of economic factors. Data suggests economic activity has slowed from the third quarter's strong pace. Inflation has eased but remains elevated. Economy is slowing though in Q4, as well as remains strongly committed to 2%. I mean, that's all normal. That's totally expected right there. Then if we go into, let's see what the suits are saying. The dot plot implies, well, it's still right here. The dot plot shows median year-end projections for the Fed fell to 4.6%. Let's go. Let's freaking go. That's very good. So then we have that. Then we've got FOMC dot plot implies 0.75% rate cuts. Yep, I already read that off. They're probably listening to our stream though, so that's okay. Odds for a March rate cut now above 60%. We're at nearly 60%. How is? I mean, I don't think Jay Powell's going to hawk us today. I went into this thinking Jay Powell was going to be soft on us. And I think that's because inflation's coming down and they don't actually want to cause a recession. Remember, he gets a statue somewhere. It might be my backyard, but he gets a statue if he sticks to soft landing. We will make Jay Powell great again.
Just close the fucking door. Close the door.
Okay, so, okay, let's see here. FOMC, let's look at the rate tool just to see how rates are moving here. We've got January, we are pricing in a 95% chance of a hold. I don't think this is updated yet. Yeah, no, it hasn't updated yet because March is only pricing in a 58% chance. So I need another about 15 minutes or yeah, that's about 15 minutes behind. Okay, so that tool is 15 minutes behind, so we'll have to wait to get updated projections on that. And yeah, this is incredible. I mean, talk about signaling here. Look at this, folks. This right here, this is the money, honey. This is great. Somebody says this is very dovish to me, head of some currency strategy dude suit. Instead of going 1 to 2 cuts next year, they upped it to 3. Now, I doubt whether Powell will even try to sound hawkish in the press conference. Yeah, how could you possibly sound hawkish? Like, he's basically saying, buy calls, baby. Oh, my gosh. Okay, getting away from China dependence. I mean, I kind of like the Chinese deflation right now. Somebody says you need a new Christmas sweater. Bro, I got like 3 of them, okay? Come back tomorrow. I'll wear another one. First move is always the wrong move. Where have you been the last 2 years, man? Instead of a rug pull, we got a magic carpet ride. That's a good point. Let's before we cheer, let's finish Jay Powell's press conference. Yes, I want to see that Jay Powell statue in Kevin's backyard. Backyard? What? Front yard. I want everybody to see the statue of Jay Powell. All right, so is this good news? Yeah. This is actually good. It is a sign that the Fed is finally waking up to realizing that they've done enough. They've done enough. And as long as we stay on this track, we're going to get inflation down, and then we could just cheer.
The lead.
Yeah. All right, good. So let me get the actual Fed statement, although I already read most of it out from the tape. Okay, let's get the statement. Statement. Print. All right, here we go. So we're going to look at the Fed statement. Then we're going to create our Fed bingo card. Remember, we've got about 20 minutes to go until Jay Powell speaks. This is the press release. Recent indicators suggest that growth from economic activity has slowed in the third quarter. You know what I'd really like to do is get the changed version where they kind of just highlight and they show what's changed and what hasn't changed. It's right here. Nick T. Thanks, bro. Here we go. Recent indicators suggest that economic activity expanded at a strong pace. It changed from economic activity expanded at a strong pace. So that's actually really important. Let's make a little note of that. So when I do my summary, I want to do a note of specifically that. They went from economic activity expanded at a strong pace to growth of economic activity has slowed from its strong pace in the third quarter. Wow. Okay. All right. That's at some point though, that does get concerning, right? You start knocking on the door of recession, you're going to have problems. So think about it. To some extent, when the stock market goes up, people spend more money again. And so if Jerome Powell's like, we're softening too much, pump it. you know, and then, you know, stocks go up and people spend money again. They go buy Teslas, you know? So yeah, Enphase just went positive.
Gained the lead.
Let's go. Oh yeah, actually Enphase was dropping earlier because CPI wasn't as weak as people had hoped. Enphase, oh my gosh, it went positive. It shows you how interest rate sensitive this is. Holy smoke-a-dokas. I mean, we had like an 8 or 10% swing on Enphase today. Holy smokas. Etsy's still down 4.5%. Tesla's still down 1.25%. What does this mean for like Nvidia? Oh, Open Door loves it because of real estate. Let's go. Affirm Holdings 5.8% to the upside. Let's go. Redfin up 2. Matterport up, getting some of the small caps. We've got Nvidia up 1.6. Let's see here. Wow. So somebody left a comment earlier, like, I'm sick of the baby talk. Like, Kevin, stop with the baby talk. You know what I have to say to you? Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is... Yeah, that one.
Is that clear?
Wrong button. Anyway, all right. So Jerome Powell, 19 minutes. 19 minutes. Let's go. Let's go make our plot. So we're going to make our bingo board while we look at some reactions here. Also, let me see what else changed in that statement. Inflation has eased over the past year. Whoa. They changed it. They changed it from inflation remains elevated to inflation has eased over the past year. Wow. That's really, really cool. Wow. Okay. I like seeing this. Let's briefly listen to see what they're saying here. Then we're going to make our bingo card.
I think strong case for the soft landing. I think she made very compelling argument saying one of the reasons that I'm getting into the soft landing camp, she said, is because in the past, inflation expectations were not well anchored, like in the 1970s, or were well anchored. There were expectations that inflation was going to be higher for much, much longer. And she made a case saying that is not what is happening here. And that is one of the reasons we don't feel the need that there's going to have to be suddenly high unemployment. She made a case for the soft landing on the idea that inflation expectations from higher for longer for a long time is not going to be happening. She got a little present here from the Fed. I mean, in PCE core 2.4%. It was 2.6. This is for 2024. Fed funds 4.6. That's quite a drop, 0.5% from prior expectations. So the Federal Reserve obviously has some expectations as well that inflation is not going to be some kind of permanent part of the landscape. So Yellen, I'm sure, is quite happy with what she sees here from them.
Rick Santelli, if you were going to give a grade to the Fed and its statement.
Yeah, I don't really care about Rick giving a grade. Rick is kind of he's a little bit of a bear. So when it comes to what the Fed's doing, thanks, Lauren. You want to come say hi? No, oh, she's leaving. She's here. Everybody say hi to Lauren. They're saying, come show yourself. No. Okay. All right. Inflation has eased over the past year. It was written in, and you can see that right here. In determining the extent of additional. Whoa! Look at the any ad. Look at that ad. Oh man! Look at that ad. That's a hashtag right there. Okay, so in determining the extent of any additional policy firming. So that's really interesting because before it would have read in determining the extent of additional policy firming. Now they're basically saying if we do any versus not. Wow. That's really interesting. Okay. Okay. Let's make our sheet. So let's do bingo, Fed bingo. We're going to take this table right here. There are definitely going to be questions about the bingo or this table here. So I need suggestions. We've got J Pow talking in 15 minutes. We're going to put a bingo card together for what we think is going to get said. J Pow's been leaning really dovish. So you know what? I think we need to start putting in some dovish stuff over here. Like we want to win, okay? We want to win bingo today. So let's draw something that's gonna win. Hold on. I know. There. One box. I think we're gonna win today. I think we're gonna win. Okay, let's make a real one now. So 1, 2, 3, 4. 1, 2, 3, 4. All right. Okay. So what are we going to put in? Do we think he's actually going to go for flexible average inflation targeting? So let's go for, I don't think so, but if we see it, it'll be a good bonus. So let's go ahead and put fate over here. I think fate is what you talk about when you start cutting. So I don't think we'll get this. Opportunistic disinflation. I don't think we're going to get that, but we'll put it on the edge. I will go ahead and put data dependent here. Data dependent. Okay, then we got to put in, well, what else do we want to put in? Job growth. Yeah. Slowing job growth. Slowing on jobs, right? Not over tighten would be good. How about some talk about slowing on rents? Rent slowing. I'll do like rent and housing. Rent and housing slowing. Okay. What else? Let's see here. Well, he's probably going to say something about the table, right? So let's think about the table here. Fed funds rate projection. So wait. Wait a minute. Jerome Powell has told us we have not had the discussion. He's always been saying we haven't had the discussion yet about rate cuts. We aren't even talking about it yet. Did you start talking about it now? I don't think so. I think he's still going to play it off as if, nope, we're still not talking about it. So I'm actually going to say still not talking about cuts. Still too soon, right? We're going to put that down. I'm going to put that right here because I think he's going to say that. And you cannot be talking about it, but be projecting it, right? Okay. Still not talking. Okay, what else? I'm looking here. Tight landing. Soft landing is actually a good one. Soft land. I'm going to put that over here. Then we're going to go dual. Yeah. Dual mandate for sure. That's like a freebie, I feel like. So let's put, that's a good one though. Dual mandate. Okay. So let's see. That he'll say F you. Yeah, I don't know about that. Consumer spending, the consumption. So like retail, but what is he going to say? Retail sales, consumption, slowing, but let's go with slowing, but still strong. Just see if he gives like any kind of sympathy to that sector. Okay. Dual mandate, transitory. No, I don't think they're going to do transitory. Oh, that they're going to maintain bond buying, right? Maintain bond or bond selling rather. That's QT. That's clear. Let's see here. Additional cuts, inflation expectations. Good one. Yes. Inflation expectations. Yeah, very good one. Is he going to mention the word recession? avoid recession. Okay, let's see if we could do that. Financial conditions. Ooh, wage price spiral. These are good. Wage spiral. I'll put no. No evidence. Wage spiral. And then loosened financial. Yeah, we need something like basically loosened financial conditions are okay, right? Loosened fin conditions okay. That would be good. Mentions crypto. For life insurance, go to, oh yeah, thank you for that. Make sure to go to meetkevin.com/life or metkevin.com/life to sign up for life insurance in as little as 5 minutes. Paid promotion. Then we got banking situation. And you'll probably mention it, but probably just that banks are resilient. I mean, I think that's a freebie. I'll give it to us. Banks resilient. And that's pretty reasonable. Continue to reduce balance sheet. Yep, that's the QT. Inflation Reduction Act. Probably not. When? Middle of next year for rate cuts? I don't know if he's going to go for that. I think it's going to say still too soon. We'll be data dependent on that. Let's see here. Election year, core inflation sticky. Oh, bumpy. Bumpy is a good one. Inflation bumpy. I like that. I made the analogy earlier. That's kind of like the bumpiness of weight loss. Or we could talk about the float. All right. Float would be really interesting. Talk about Argentina. Doubt it. Everybody out here buying calls, and Kevin is making a bingo card. Yeah, the election. Okay. I'm going to say election / no political interference is what they'll argue. They're going to say that. Of course, they're going to say that. What if they say like, yeah, money markets. That's a good one. A lot of cash in money markets. Like something like that. That's interesting. Okay. Like that. Core sticky. I don't know. Did we already do? Oh, yeah, that's bumpy inflation. Geopolitical uncertainty. I like that one. Geopolitical uncertainty. Okay. Orange man, good. I'm not writing that one down. Stimulus. Can't write that one down either. Is he going to use the iPad or paper? iPad, paper, or teleprompter? I think he's going to go for, watch. I think he's going to go, okay, this is a bet. This is the corner bet, okay? The edge case. I think he's going to go back to paper. I think he's going to be like, I didn't like the iPad. I didn't like the teleprompter. Just give me my damn papers. Okay. All right. I need 3 more. Oil. I like that. Yes. Oil price decline. Did we do inflation expectations already? Yes, we did. 2 more. Two more. Use all of our tools at disposal. Committed to 2%, basically. Okay. I guarantee you he's going to say that. We're going to win today. We're going to win today in Bitcoin. No more war on time. On time. Yep. That's a freebie. I'll take that. He's always on time. Real estate jobs. I think we got both of those. Rent and housing slowing on jobs. He's not going to mention crypto, I don't think. That would be an edge there. Climate protesters, dollar stability. You know what? That's a good one. European and Chinese disinflation. So foreign deflation. That's a good one. I like that. Watch, he talks crypto. Hey, guys, I'm all in on ADA today. Okay. All right, Trump. Oh, I love it. All right. Bingo card set. J-Pow gets started soon. This is going to be exciting. So obviously we'll be covering J-Pow live here. We'll add commentary as is appropriate and necessary. But this is exciting. So let's get... Oh, that sounds terrible. I'm going to get like demodded. Turn that crap off. What is this? All right. So there we go. All right. We'll have it ready. Let's go see what else the suits are saying. But this is fantastic. And okay, risk assets have taken off. S&P is up 0.8%. Small caps up 1.3%. Bitcoin is up 3%. Most shorted stocks are up 2.4%. For the first time in this cycle, the Fed is appropriately anticipating the fact that inflation is likely going to continue to decelerate. Wow, that's a big line right there. Big line. First time in cycle, seems like Fed is convinced inflation is trending down. I like that. What are we doing with yields? Let's go. We've got more. Okay, here we go. See, here we go. Bonds, 13 basis points on the 10-year. That's where we were earlier. They'll plummet even more. TMF, let's go, baby. This is the wake-up call. TMF to the moon. That's the triple leveraged treasury short inverse. Boy, that's a mouthful, isn't it? The 2-year treasury yield is down 20 basis points. That means we just got curve steepening by about 7 basis points. So we should be at negative 45 on the 10-2. Let's see. 10-2, 10-2. Yep, negative 45. Nailed it. All right, let's see what the 5-year break-even's doing. Come on, baby. Give me under 2. Under 2, baby. Under 2. 2.8. 2.08. 2.08. Wow, that barely moved. Did this not update yet? That's crazy. Last price. Yeah. That should be lower. Maybe it hasn't updated yet. Anyway. Okay. As expected, the statement has fairly modest changes. The interesting addition of any to the front was a big deal. The hold was obviously widely expected, but are the markets pricing in too many or too few interest rate cuts from the Fed? Take our ultra short MLive survey. Boring. More caution ahead of the Fed briefing. We'll see whether the rally is set to fade. Yeah, well, we'll see. I don't know how J-Pow's going to hawk this one. It's going to be really interesting. Let's listen in here for a moment.
And interest rates have dropped. Let's take the 10-year by, almost 10 basis points. What's the significance of that? And do you expect the Fed chair to push back on it at all?
Well, I think in the Q&A session, I think he will try and push back on it a little bit. I think if you look at the summary of economic projections, yes, they say that the federal funds rate could be between 4.5 and 4 3/4 by the end of next year. So that implies 3 rate cuts. But he could say, look, even if that's right, that could be in June, September, December. So we've got a full 6 months at least based on the SEP before we would have to think about cutting rates. So I think he will try and push back, say, look, for right now, we're not sure that we're done with rate hikes. We're not sure that we're there in inflation. It's too early to say. So I think he'll be pushing a lot on that, even though this was a relatively dovish statement and the markets are correctly responding to that.
Do you think he's theoretically on board with the idea of cutting rates as inflation falls, even if the economy hasn't slowed down substantially?
Well, in theory he is, but of course, the Federal Reserve is historically late in every move. So, they may find some excuse. It's like, everybody's got a friend who's always late for an event. And no matter how much they promise you they're going to show up, they're going to be late. Well, that's like the Fed. So the Fed...
Fed's never late, bro. Chill.
Inflation, but I think they'll still mostly be thinking about, okay, inflation's getting better, but do we really need to move yet? And that'll tend to delay them a bit.
My wife and I are those guests. We're terminally late. But I come back to it, and I mention it every time, David. When we began this rate hiking cycle, you said typically the Fed is too slow to move, then they stay too high too long, and they wait to cut too long, too late. Yeah. And so that is really what you're driving at here yet again, and correctly, yeah. I think.
Well, yes, because the economy is growing more slowly, but what this economy has proved in 2023 is you can have strong growth, you can have below 4% unemployment, because we've been below 4% for 2 years. You can have all of that with inflation coming down. So, why mess with that by keeping rates this high?
Let me ask you a political question. Why does Joe Biden seem to get no credit and only blame for where inflation is and for the fact that inflation has come down? Why does the administration seem to get no credit for low unemployment and really relatively strong growth? Why?
Well, I think part of it may be, the clarity of messaging, to be honest. Mm-hmm. I wonder if Ronald Reagan or Barack Obama were making.
This guy sounds German. All right, is J Powell going to be on time? It is 11:30. Is J Powell going to be on time? Okay, ready? This is the first one. Let's go.
Just close the fucking door. Close the door.
No, open it. Open it. Open the door, then close the door. We need J Powell to be on time because this is part of our bingo card. It's always on time. If you haven't yet taken a screenshot of the bingo card, take a screenshot really quick. 3, 2, 1. Okay, good. He had me in it. Anyway, dude, where's J Powell? Don't be late. The one time we put it on our bingo card. Is he here? Oh, here he is. Here he is. Yay, he's on time.
Let me interrupt you for Chair Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
That's 2.
As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
Okay.
I will have more to say about monetary policy after briefly reviewing economic developments.
Let's go.
Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions.
Okay, consumption.
After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come under balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%.
It's a laptop.
Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate.
He's distancing himself again.
Employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored.
Good.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
Moon.
So Specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle.
Let's go.
Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Woo!
Mr. Chairman, the microphone, sorry.
Over.
Steve Leachman, CNBC. Happy holidays, Mr. Chairman.
Christmas
Governor
gift.
Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question. And
yes,
that's what people are thinking about and talking about. And I would just say this, we are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Ooh!
The nature of that discussion today. Thank you.
They talk, dude. They talk rate cuts today.
It comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was. And there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Rachel? Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now.
He said recession.
I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters would expect very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. It didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
This is good.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year. Whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. Yeah. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down they basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor. And it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter. And as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that I could follow up has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Steve called this.
We don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward. But that's another assessment that we're going to make very carefully. So as time goes forward.
This is good.
Nick Timmeros of the Wall Street Journal.
Here he is,
Chair
Nick
Powell,
T.
you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth. And, I'm just focused on what's the right thing for us to do. And my colleagues are focused on that, too.
Total dodge. Nick T should have known he wasn't going to answer that.
Credibly. Do you believe we're at the point where inflation is coming down credibly?
Good change.
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way,
smart.
Is below trend growth necessary to cut rates, or would continued progress on inflation alone?
Below potential trend. Where were you last week?
Totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, if we make decisions about policy changes going forward, we're looking at all those things, and particularly as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
Potential.
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Good, Neil.
That's kind of a waste of a question. She usually brings good questions. I like her.
How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation.
Yep, we got that.
The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say.
He wants 3.
I guess there are just a couple of other. The unemployment rate is very, very low, and these are. But I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire?
3% on wages is consistent with 2% inflation.
Yeah, I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
Good question, actually.
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now real wages are now positive, so that wages are now moving up more than inflation as inflation comes down, and so that might help improve the mood of people. But we do see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Good answer.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Yeah. So yes, we'd cut rates.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
Ooh, I like it. Oh.
So we're aware of the risk that we would
overtime
hang on too long. We know that that's a risk, and we're very focused on not making that mistake.
I'm checking that one.
We do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median growth, median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens? Or will you tie it to some particular measure of progress?
Meeting by meeting.
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
Yeah, good question. Good question.
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are, and we tabulate them and publish them. So it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and doesn't need the tight policy. It depends on the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report.
Let's go.
So, yeah.
That's amazing. It's so amazing. Like this coupon code for the gold course ending tomorrow. Go check that out at meetkevin.com.
I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecast we see today.
No, they weren't.
But I just wanted to ask, how that kind of adds to your thinking,
They were.
on the inflation.
Because they get them early.
So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Good. Hey, man, email us at staff@meetkevin.com if you need a special bundle code or whatever for the courses. Staff@meetkevin.com.
Or whenever they come. How do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this, difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
3% would be reasonable.
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the US economy?
I think I think this, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the US economy.
Yeah, so it's not that it may or may not be about the US economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand without question and unusual supply side restrictions, both on the goods side, but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view that we could get a lot of, you had essentially a vertical supply curve because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run, we definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance. And, it's so far so good, although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we're going to make it for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking though the question, I guess you're implying the question of can can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. You know, if you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
Yeah, we're so close
Thanks
to
very
bingo.
much.
Come on. Oil. Deflation in Europe. Thanks.
And with that, welcome to Closing Bell.
What?
I'm Scott Wapner here at
What?
the New York Stock Exchange.
What? He just
Spencer
walked away? That was it? Dang it. We didn't get bingo. What the hell? Come on, man. What is this? Ow. Fire. All right, let's do a summary. There's a lot to distill here. The first and most important thing to distill is happy and Merry Christmas and holidays, and check out the gold membership coupon code, which comes with course member live streams. It's $420, $420. It's our favorite number. You get all the new lectures, all the Noob vs. Pro courses, all in one, all the new lectures coming out at the end. It's all the brand new stuff. We got all the other ones you can bundle up with as well if you want, like the AI course, which is great, property management, 0 to millionaire real estate. But you want to get started and see some of the stuff we got, gold membership. And then December 31st, we're coming out with even more new content. Now, with that said, let's get an update on the Federal Reserve. Okay, 3 seconds. Well, J-Powell just flipped the script as a big old Merry Christmas to you. Yes, Merry Christmas and Happy Holidays to you from your friend J-Powell and his buddies at the Federal Reserve. That's literally what we got here. Now, we have to understand the longer-term implications of this, so I'm going to start with the longer-term implications, and then I'm going to talk about what J-Powell just said, but this is going to flip expectations. It is a big deal. Look, let's be clear. There are a lot of money market assets sitting on the sidelines. Total assets in money markets have absolutely exploded. They've exploded, as you can see by this chart right here. They've exploded because of all the massive, crazy money printing. They were somewhere right around before COVID. They were somewhere right around 4 trillions. They're sitting somewhere around 6.2-ish right now in money market funds. And that's money markets. That doesn't even count the money that's sitting in bonds ready to dive back into stocks. This, in my opinion, is the signal. Jerome Powell today, for the first time, suggested we are at or near the peak. He's basically softly trying to say we're done. Unless something dramatically changes, the Fed is done. That is the clearest signal you could possibly get to buy treasuries from Jerome Powell. Whether you want to use that signal or not, on you, not personal advice. The 10-year treasury down 16 basis points right now. The 2-year down 25 basis points. That's great. That is a normalizing of the yield curve. And if you don't know what any of that means, it just means stonks up. It's a good thing. And Jerome Powell seems, and the Fed seem convinced that we're not actually, certainly not in a recession right now, but also not necessarily heading to a recession. Yes, could there be a recession? Yes, but Jerome Powell made it clear. We're not seeing any evidence that right now we are in a recessionary territory. Instead, what we are seeing is that all 3 levels of inflation are trending down. Goods inflation. He had a great quote. He's like, I don't know, maybe people aren't buying stuff anymore because people bought enough stuff and now they don't want more stuff. That was a quote. Anyway, goods disinflation, housing disinflation, core services disinflation. It's starting. And the Fed is finally waking up to realize we don't want to over tighten. As a result, what do we have? An over 60% chance that we're going to get rate cuts in February. Boom. Number 1. Number 2, 10 years about to drop below 4%. This is very bullish for stocks. It's also bullish for bond prices. Yes. Next, what does it mean? It's probably going to start the transition. And this is the euphoric rally I talked about. We made a video about this, and I warned that this could come. If you're not joining me, by the way, every day the market is open. We talk about this every day. Totally free. We got poverty chat on. It's great. Everybody can join, and it's great. Every day the market is open at 5:25, we cover the market open. And you can ask your questions, whatever you want. But I made this video on December 8th called Warning, Stock Market Euphoria is Coming. There it is, Warning, Stock Market Euphoria is Coming on December 8th. And I talk about how when the Fed signals that U-turn, as soon as we hit peak, the market will probably go euphoric. Absolutely euphoric, which is fantastic because it's a way of Jerome Powell saying, look, we've done enough. We've put people through enough hell. Now let's actually try to prop the economy up again by letting asset prices go up. Let people get richer again. Let people make more money again, and then they can keep going and buying stuff for the economy. Now, what's very interesting, which a lot of people missed, he was asked, hey, man, but prices are still high. And he's like, that's true. And you know what we're doing about prices still being high? You ready for this? This was priceless. Did you catch it, what he said? What is Jerome Powell doing in response to prices being high? Well, real wages just went positive, so hopefully you'll make more money to be able to pay more. Yes, that's basically literally what he said. When he was asked about prices being high, he said, well, the good news is wages are going up. So that is true. We just barely went positive in real wages, but it is a way of the Federal Reserve saying, hey, don't expect us to bring prices down. We are going to turn the money printer on well before we need to make sure we don't go into a recession. And when J. Powell sticks this soft landing, I'm putting a statue of the guy in my front yard. So what else? What else did he actually say? So economic activity expanded at a strong pace. We held rates stable. Inflation has eased over the past year. They added the phrase any as to whether or not they would raise rates at all anymore. And then, of course, in the Q&A, he suggested they're done. He suggested that housing has flattened out. We're seeing a lot of rents down across the country year over year, certainly at least flat. So slightly down or flat, very, very common to see across the country. Does indicate he believes we are at or above peak. I think this is a great signal for real estate. There are a lot of real estate bears out there that think this real estate market's going to crash. I'm in this damn real estate market every single day. And I'll tell you, there's volatility week by week. Like one person farts in a house and all of a sudden nobody's buying it. The next week, there are 20 offers on it. The real estate market has almost gotten as volatile as the stock market. It is really insane. You just don't see the candlesticks, but it's just people's emotions. It's all the same crap. Business is people. This is obviously, I mean, we talk about this in the courses. Business is people. Stocks comes down to people's emotions, and real estate comes down to people's emotions. Very, very simple. But anyway, they actually talked about rate cuts. They had the discussion about rate cuts. One of the reasons I did not get bingo on my bingo board, which was a pisser, I was so confident we were going to get bingo. So confident. And we were so freaking close. But one of the reasons I did not get bingo is I had to put this blue X here because I wrote that they're still not talking about rate cuts. No, they actually started talking about rate cuts today. Yep, started talking about rate cuts. What a game changer. What a flip. It's been 2 years. You remember the worst Fed minutes ever? Like, who here remembers it? We covered it on this channel. Federal Reserve, the worst minutes I've ever read in my life. Those were from the December 2021 meeting. December of 2021. What the hell? Oh my gosh, it's been 2 years. Anyway, so let's go ahead and keep going here. So we've got inflation levels of the 6-month, very, very low, 12-month, also trending low. These are important levels to look at. It's not the month over month that matters so much. It is important that we actually end up looking at those trends. Nick T does a good job of posting the trends. We can go ahead and pull up some of these trends. Here's an example for you. This is the CPI right here. Look at that 12-month trend, that dark line right here coming down. The 6-month trend coming down. Both of them down. Both of them mentioned by Jerome Powell. Inflation expectations low and falling. Great. Didn't get any talk about oil. I was surprised by that. Or foreign deflation. Although those are other factors that are also leading inflation expectations to plummet. Wages still a little bit above trend, so still want to see a little bit of restrictiveness coming into wages, though he thinks we're already on that trend. We're at about 4% for wage growth. We want to be at 3%. 3% is where you want to be. Again, the reason you want to be at 3% is because roughly, if you want to do math to it, consumers make up roughly 70% of the economy. So if you take 3%, 3.0 times 0.7, you get about 2.1% inflation, right? That's just a quick math way to kind of look at that and fact check yourself. Unemployment rate still very low, positive developments. Recession is not our base case, not seeing signs. The S&P or the summary of economic projections is not signaling weakness. The SEP signaled 3 rate cuts as opposed to the 2 markets were expecting the Fed was going to signal. Keep in mind, markets have been pricing in 4 rate cuts, as much as 5 recently. We were not expecting the Fed to come out and give us 3 rate cuts. Jerome Powell suggested that those at the Fed sort of incorporated the latest CPI and PPI report. And he said, we can't wait to cut rates until we get to 2% because you'd be way too late at that point, 2% inflation. So did talk about slowing quantitative tightening once they get to a level they feel comfortable. They're not sure what that level is. They do think that level will be above the level of where it used to be. This is the Federal Reserve's balance sheet. Jerome Powell mentioned we're about $3.5 trillion above where we used to be. My guess is we'll probably, honestly, if we level off at about $7 trillion, that's probably where we're going to level off. Now, why would I say we only have about $700 billion of QT to go? Why would I say that? St. Louis, Fred, spell correctly here today. Louis, Fred, we're going to go with Fed repo facility. Reverse repurchase agreements. Look at that. Look how much money we have left here. $823 billion. So 8 to 700 billion to go. That'll bring us to about 7 trillion of a Fed balance sheet. And I think they're done then. That's when they'll start slowing or just stop entirely. So what does this practically mean? Look, in the short term, this is fan-freaking-tastic for inflation-sensitive stocks, interest rate-sensitive stocks. This is great. In the longer term, this will eventually be very good for your energy style stocks, your Enphase, your Solar Edge. The break-even cost on energy will come down. It should be supportive to the housing market as now you're going to get people starting to speculate. They'll be able to refinance back at a 4 or 5% mortgage next year. You're going to start getting that speculation priced in starting now. It's one of the things that's been keeping a floor under the real estate market is not just low inventory, but people speculating that prices will stabilize. And so buy what you want now. So that's important. Now, there is a fear that there'll be a flood of housing that hits the market in the spring as interest rates start falling. I don't know if that's going to happen. Nobody knows if that's going to happen. Obviously, if there's a flood of inventory, the question will be, well, how many floods of buyers are we getting? Are we getting more buyers or not? I kind of think things will stay kind of the same and flattish, that we don't need to expect some huge rallies. Just get out there and go buy good deals, which obviously I will teach you how to buy good deals with an introduction, even in the gold course. Gold course is a great way to get introduced to buying real estate if you'd like. So check that out. Gold course. Remember, it's $420. So check it out. Go to meetkevin.com and email us for a bundle coupon at staff@meetkevin.com. It's amazing. It includes all of the Noob vs. Pro courses, course member live streams. It includes a lot. If you want the individual courses or you want to bundle up, email us at staff@meetkevin.com. You have 3 levels here as well. You can get all the courses, the gold membership or the diamond membership, which includes following us around as we go buy real estate. And you can see what it's actually like to go buy real estate and what we actually look for in houses. And you can talk to me and ask questions. So anyway, check it out. Go to meetkevin.com if you got questions. Staff@meetkevin.com. I appreciate y'all being here. This is fan-freaking-tastic news. And make sure to join me every day the market is open at 5:25 a.m. on the Meet Kevin live channel. Thanks so much for being here.